Welcome to our webinar, which looks at managing businesses emerging from lockdown. I'm Sandra Mundy, a business restructuring and insolvency partner in James Cooper Creston, and I have with me my colleague Fiona Hawkins, an audit and assurance, and also our outsourcing partner. There is a facility if you would like to ask questions online, and we will then answer those at the end. So please type away if you have any questions.
Sandra, good morning. Good morning, everybody. Sandra, so much has happened in such a short time. Can you just provide us with a quick recap?
Of course, Fiona. So it really started hitting the headlines when the first coronavirus death happened in the UK on the 5th of March. Shortly after that, we had the first budget of the new government, and then we were sort of looking a few days later at a further announcement by the government of putting in £330 billion as opposed to the 30 billion that they'd said in the budget just a few days prior to that, to support the economy during the coronavirus pandemic. We then get on the 20th of March an announcement that schools, bars, pubs, cafes and restaurants would be closed, and the announcement of the furlough scheme. And by the 23rd of March, we were actually all in lockdown.
So can you also just remind us of some of the key announcements that were made after the lockdown announcement?
Yeah, of course. So following the announcement of the furlough scheme, there was rightly a further announcement about the self-employed having help during this time. We then obviously get our poor Prime Minister being very poorly. We've got, quite interestingly, a doubling in people of reporting symptoms of anxiety and depression. And I think at that point in the sort of the end of March, beginning of April, something like 40% of the population were reporting either symptoms of anxiety or depression. We then get the 20th of April the online application for the job retention scheme, and I understand that there was something like 67,000 applications in the first 30 minutes for that scheme, and now a quarter of all the workforce in the UK are actually on furlough. 5th of May, they start trialing an app on the Isle of Wight for the track and trace, and we're told that that's a game changer, but I think we're still waiting. We're going to be waiting for some time on that to be rolled out more widely, and possibly by the end of the month. And then 7th of May, which is quite an alarming sort of thought, the Bank of England warns that the economy could shrink by 14%. I think, Fiona, you were saying that that's the largest shrinkage since 1720 or something. Was it that right?
Yeah, well, according to the Financial Times, the only time previously that there's been a recession deeper than the predicted 14% is 1709. The Great Frost caused a recession. So, Sandra, what do we know about the restrictions that have been eased, and what do we know about what's going to happen in the future?
Yeah, sure. So we've seen some businesses start to reopen. So garden centres have reopened to some extent. 10th of May, the message changed from stay at home to stay alert, not stay at work, sorry, and that more people should go back to work if they cannot work from home, which then saw the likes of the construction workers, manufacturing and estate agents back to work a few days after that. We've then seen various announcements about the furlough scheme, the most recent of which suggests that the furlough scheme will end on the 31st of October, but there will be a gradual phasing out of that, such that employers will need to pay national insurance and pension contributions from August, and then 10% of pay from September and 20% in October. 1st of June, we've started to see the reopening of schools, although this morning I heard on the news that the full reopening of schools is very unlikely ahead of the autumn term now. We've also seen the opening of outdoor markets, car showrooms, sports centres and sporting fixtures, with horse racing back this week. 15th of June, non-essential shops are due to reopen, although quite what that will look like, I don't think it will look the same as prior to lockdown. And then beginning of July, we should start to see some of the hospitality businesses reopen, provided that the infection rate is not rising at that point in time. But there will be other businesses where social distancing is very much more difficult, which could open significantly later. So, Fiona, I was just wondering, you work with many businesses, and some of those have been sort of very adversely affected by lockdown. And I was just wondering whether you could help us with some ideas of what you've experienced and what you've heard of.
Yeah, that's right. So some sectors have generally been able to weather the impact much better than others. Some indeed have seen increasing levels of business. What's definitely not the case is that all businesses have been in a position, in whatever sector, have been in a position for whatever reason, whether it be funding, staffing, logistics, to take advantage of the opportunities. So to really benefit, I think businesses needed to be nimble. They needed to be able to react quickly. As we could see from the timeline, you know, things happened very, very fast through March and into early April. Sectors that we'll all have seen in the news, healthcare, food, not just the supermarkets. I do a lot of work with farming businesses, farm shops, where they've been able to move quickly to online or telephone orders or even just emails, and have been able to organise either delivery or a pickup system, have been very busy and you know, very much valued by people using them. The delivery network has been extremely and continues to be extremely busy, increase in online businesses and also online consumer spending.
Did you tell me that your husband worked in the sort of delivery network and he'd seen a huge uptick?
That's right, he does, and they're busier than they are at Christmas at the moment. You know, have got people working double shifts to just try and clear the volume of parcels that are coming down, as I say, both to businesses and to individual homes. And then the other area is technology, from people working from home through to the high-tech sort of biomedical work that's very much of a focus currently.
And obviously some businesses have been actually quite adversely impacted by this. And what have you seen there, Fiona?
Again, thank you. Yes, again, all we're probably from the news of all aware of businesses which have been very badly impacted. Leisure and tourism, travel, national and international. You can't avoid the headlines in those respects. Also, retail. You mentioned earlier about non-essential retail opening from the 15th of June. Well, as I say, we'll have to see how that goes. Retail businesses that have been able to move online or that already had a strong online presence has obviously been impacted in a different way from those that didn't. The housing market, we're just beginning to see that reopening. Estate agents were back to work a little while ago. I've heard over the weekend of a couple of people I know who sold houses very, very quickly, perhaps surprisingly so, but maybe that's an indication of some pent-up demand there. Also, not on this list, but there's been both a very, very significant direct and also knock-on effect, which I think will be quite long-term on many in the charity sector. And then there's discretionary spend areas. So in times of uncertainty, as we'll all obviously been very aware, people are less willing or less able to spend, and those discretionary spend areas are where they sort of withdraw their spending from first. So some of the businesses clearly are tentatively back to work, and others are due to return over the next few weeks. Sandra, what guidance have been given by the government in terms of getting back?
Yeah, the government have issued 8 different guides, and actually they're quite useful. I've gone and had a look at the ones that are pertinent to our business in particular, which obviously is working from offices and as they say, contact centres here. But the 5 steps to working safely are also universal to all businesses, and they're certainly worth looking at. But yes, so definitely would recommend that anybody in any of those sectors look at the relevant guide for them.
So you mentioned that there is some guidance that affects all sectors, the 5 steps that you talked about. Can you give us some edited highlights of those?
Of course. It is a legal requirement to have carried out a risk assessment, and that covers COVID-19 for each and every business, and that must be documented if you've got more than 5 members of staff. We've obviously gone and started to do that procedure in our own offices ahead of a potential reopening. And interestingly, I was talking to our HR director, and he was saying you're having to measure things very accurately to make sure that you can achieve the social distancing of 2 meters, or if you can't, you're thinking about plans for back-to-back or side-to-side working. Also thinking about workflows around the space. So can you put in place a one-way system, that type of thing, to reduce contact? And then there's things like thinking about touch points, such as door handles, kettles, equipment. If for example, you're using a bit of equipment on a number of shifts for a manufacturing business, the cleaning of that between the various shifts to make sure it is safe for everyone. So we've obviously sort of had a look at those type of things, but Fiona, we've sort of so there's an interesting sort of impact on staff as well. So we've done our own staff survey within the firm, and we would recommend that everybody else do, because I think the patterns of work going forward probably may well have changed forever. Employers really do need to think about the mental health and well-being. As I was saying, there's huge reported increase in anxiety and depression, and actually just getting people back into the workplace, having been out of the workplace, especially if they've been on furlough, and having that a period to adapt and change. Then firms will need to think about, staff may well continue to need to self-isolate from time to time, and whether they're going to pay statutory sick pay for that, or whether they're going to have their normal sick pay type arrangements. And then we've got staff that are living maybe with shielding relatives, need to have something in place to make sure that those staff are able to actually work from home, or if they're not, what policy you're going to put in place. Then you've got the consideration of equality in the workplace, and how that actually interacts with the health and safety legislation. So where you've got older workers that might be more vulnerable to coronavirus, or workers with underlying health conditions, or those in ethnic minorities, some might want to get back to work. How do you get them back to work safely into the normal environment? Some might want to continue to be at home. Can they actually work from home effectively? There are things that you need to think about. Talking with our HR director, he thought that the health and safety legislation was likely to trump the equality legislation in that respect, but that's not been tested. And then also the very practical things of actually how do people get to work. So in rural areas, it might be much easier, where people are used to travelling in, and car parking is not at such a premium. But if you're like sort of working in the capital, for example, then getting into the city may not be easy, because public transport is not advised at this time. And then childcare, again, as I was saying earlier, the announcement this morning that schools are unlikely to be back in the fully until the autumn term. That childcare requirement is still ongoing. Assessing the businesses post lockdown. What are your thoughts on that, Fiona?
Yeah, so obviously staff is for many businesses going to be a very important factor, and each business will be individual, I think, dealing with different combinations of factors. But one thing that everybody will need to think about is, and try and understand, is demand. What's going to happen to demand? What has happened to demand for whatever their product or services are? You know, is it still likely to be suppressed, or alternatively, is there actually going to be quite an uptick from pent-up demand? I think widely predicted is that hairdressers, for example, when they are allowed to reopen, will be exceptionally busy.
There's some very dodgy lockdown haircuts out there, Fiona.
I think there are indeed. Although, of course, there might be changes in customer behaviour that will impact demand. And then obviously thinking about supply as well, you know, how is your specific supply chain impacted? Are there going to be delays? Are there going to be potentially price changes? And what about credit terms? You know, can you negotiate time to pay? Will your customers want to try and negotiate time to pay? You know, are you at risk of potentially some potentially bad debts? We don't know how the social distancing rules will evolve. I think a lot of people want to see them reduced from 2 meters to perhaps 1, as I think there's been across some other parts of Europe. But, you know, what will be the cost to the business of changes needed to comply with them? Obviously, we all think about restaurants and pubs and things like that. Can they operate profitably if they can only seat sort of 50% or whatever it may be of their normal capacity? But of course, then the other side to analyse is, can they also afford to remain closed for a further extended period? And again, you know, things will be different depending on the individual circumstance of individual businesses. I think seasonal businesses are in potentially, you know, a particularly difficult position. Wedding venues, businesses linked to holidays, where much of the income for 2020 may, by the time they're allowed to fully open, may already have been largely lost. And obviously, we've already alluded to staff issues, the cost of measures that need to be put in place, which won't be avoided if you want to be able to reopen the business. So, but I think whatever the individual circumstances, 2 key things from an accountant's perspective, 2 key things are going to be forecasting and managing the cash.
So there are some things that the business, to some extent, can control in terms of costs, such as, and there are other things that they can't. So things like the demand that you were just talking about. So what should business owners be doing about controlling the costs that they can? What are your thoughts on that?
Yeah, indeed. Thank you, Sonia. Indeed, thinking, you know, firstly about the costs, obviously, I think the first thing to recognise is the shape of the business post-COVID-19 might well not be the same as pre-COVID-19 in many different ways. And an area to very quickly get a grip on is costs. So staff costs, to an extent, the extension to the furlough scheme is clearly helpful. Some businesses, you have the ability to have furlough staff working part-time from August. I did a webinar at the very beginning of May on forecasting and cash flow management, and at the time we expected effectively a cliff edge in July, with staff coming back to work and yet businesses not yet back to full operations, which was going to have a very significant impact on cash flow, and that's been ameliorated to some extent by the government's new announcements. But one way or another, you're going to have staff costs you can't avoid. Another cost is likely to be premises costs. You might be able to negotiate a short-term reduction or a deferral in advance of any more comprehensive lease renegotiations. And then considering it from a landlord's point of view, you know, is a reduced rate better than an empty unit? You know, quite possibly it is, but there will be some negotiations needed there because they have businesses to protect as well. And then supplies, you know, consider the flexibility of supplies and the cost of having flexible supplies over the per unit cost savings of buying in bulk. Do you now have sufficient cash headroom to tie it up in stock holding as you may have done in the past, or are you better not paying a little bit more in order to have that flexibility and not tie the cash up? And then discretionary spend. I mean, obviously some businesses do have quite a lot of cash at the moment, and if they do, it might be a very good time for some of them to do some of this discretionary spend, but it will be case by case decision making and different for every business. And then I suppose the other point is there are some cost savings that, you know, or are there some cost savings that you can buy into by having your staff working more from home, both immediately and, you know, short term, and then potentially restructuring that into the longer term.
So how, Fiona, do the business owners forecast for the future in these uncertain times?
So yes, the key first step in my view is to having up-to-date data. You need to know that the position you're forecasting from is an accurate one. We've seen that businesses who already had cloud accounting at the start of lockdown had an advantage in terms of being able to have access to their data and making sure they did have up-to-date data. We're seeing more businesses looking to switch to cloud accounting following this experience, but whatever accounting system that you've got, the key thing is to have up-to-date data. And you might want to be looking at it on a really detailed basis, you know, really detailed level. When your cash balances are really tight, you're monitoring on an individual customer receipt basis or an individual payment basis, you know, payment by payment, day by day. And as I referred to on the previous slide, understand your costs, know exactly what you're obligated to paying, and you know what can you defer. The government deferrals for VAT, PAYE, self-employment deferral for the payment on account due on 31st of July. You know, take all of those things into consideration. Try see if you know you can negotiate extended credit terms and payment holidays on debt. You know, all those things are potentially available and should certainly be examined and looked at, even if it's not something that you ultimately go for. And then once you've understood all those things, then you need a base forecast, effectively your best guess of what is going to happen. And that needs to be really detailed over the first sort of few weeks, as detailed as you can make it, and then extended as far as you reasonably can. I would say at least 12 months. And then when you've got your first forecast, you need to effectively stress test it, look at different scenarios. So what will happen if, say, a big customer doesn't pay or pays over a different payment schedule than what you had expected them to, or if you have unexpected costs, I don't know, repair costs, something like that. And also, what could it look like if trade is better than expected, and what will that do to your cash if you have to be buying in more supplies before you can actually get the receipts for them. You're looking for the pinch points. You're looking to know where you expect to or could need funding, and then you can plan to get funding in place or change your plans to try and prevent those pinch points happening. And then obviously it's not a one-off process, unfortunately, and it is reasonably time-consuming, but you want to be updating it with your actuals, monitoring how it changes the forecast, recognise that you need to be nimble and you need to be ready to change, and you monitor and update on a continuous basis.
How often do you think people should be looking at their monitoring against their forecasts?
Well, it very much depends on the type of business, but I would say, you know, certainly monthly, and possibly you know more often than that if cash is tight on a immediate basis, then more frequently than that. So you know, use your advisors. They're able to help you take a broader view of the business. When as a business owner, you're likely to be very much in the detail. And using the advisors to help you with the forecasting, helping you to look at the scenarios is very helpful as an alternative perspective and as a sounding board. So but Sandra, I mean, obviously I've talked here about you know, forecasting and what have you. What happens if it is if
it's the end of the road?
Yeah, exactly. If you get to if it looks like you are actually, your solvency is threatened.
Yeah, sure. Well, there's no real established test of solvency, but there is an established test of insolvency. So I suppose maybe looking at it in the negative, and this is a lot of businesses will be considering and concerned about this at the moment. So there are two tests for insolvency, and if either of these tests are met, that a business can be described as insolvent. So as you were talking about, Fiona, there is a lot about cash flow. So can a business pay its debts as and when they fall due? There's a slight grey area, although I believe that a business would be solvent, for example, if it had a payment plan with its creditors. It's hard to see how a director could be criticised for continuing on if there's been entire transparency and the creditors are supporting that. So we've got the likes of HMRC saying you can defer VAT payments, but there might also be suppliers that are willing to support that business. And then there's the second test, which is the balance sheet test, and that's whether a company's assets, the value of those assets, are worth less than the amount of its liabilities, and that would be taking into account contingent and prospective liabilities. But I would like to point out that it is not illegal for directors to continue to trade an insolvent business. It just potentially means that the risks on them are somewhat greater of personal liability if it goes wrong.
So Sandra, is this? I've heard about is this the twilight zone that I've heard referred to? And if so, I presume some businesses will be like this for several months. How should the directors seek to manage the risks of potentially trading when they're insolvent?
Yeah, you're absolutely right. It is the twilight zone. It's that sort of shady area between is the business solvent or is it insolvent? And that may vary month to month, week to week. And you're right, in the next sort of few months, it's going to be high on the radar for a lot of businesses. So in that period, the directors should really be focusing on protecting the interests of creditors, so shifting away from creating shareholder wealth to protecting the interests of the creditors, and that should serve them well in the long run if things don't go to plan. Directors really need to understand their obligations and their duties and all that piece that you were talking about monitoring the performance of the business and against the budgets that you've prepared. It is vital during that time. And if there is something going wrong, to take advice early and act appropriately on that advice. And certainly where you've got a number of directors in a business, where you've maybe got some non-executive directors as well, they really do need to take an active part in the business and be aware of what's going on, and understand what your fellow directors are up to as well, because you're all in this together, and potentially if things go wrong, you could be all liable for the impact of what has happened. And that's the way that you mitigate some of these personal risks that you have. So you were talking about good management information, and the monitoring is essential, and that is absolutely key to making sure that you're doing the right thing by the company and by its creditors. So regularly reviewing that performance and discussing and documenting is very important, those key board decisions, because if things do go wrong, it could be something like 6-12 months down the line before somebody like me as an insolvency practitioner says, well, what were you doing then? Why did you make that decision? And if you've got that documented and you've got on record what you knew at the time, and therefore the decision that you took made sense in light of that context, it is much easier to explain some of those decisions later down the line.
Yeah, that makes sense. What can the directors do to mitigate the risk, rather than sort of just managing what mitigation is available?
Yeah, absolutely. So I would certainly say, if you are thinking that the business is insolvent or is like to become insolvent, that you have a turnaround plan, that there's a feasible timescale attached to that. So if the turnaround plan is over a matter of months, that's probably feasible. If it's over the next 10 years, it's probably less feasible. Although, individual cases will vary in what timescale is appropriate. But you do need to be asking questions like, is continued trading advisable? And the board should be regularly reviewing that decision if the company is insolvent. And you were talking earlier about understanding your pinch points in terms of cash. And this is important in the insolvent situation. When are you going to run out of cash, and what are you going to do when you run out of cash? And if there is a deterioration from your turnaround plan, then you need to take some action, either to halt that deterioration, or if that's not possible, to think about an insolvency procedure at that point in time. And certainly if you're looking to incur more credit with your suppliers, really take those decisions seriously. Don't make light of them, because you're actually then using somebody else's money to fund your business. And certainly where they don't know about that, that's where potentially the risk for directors really do lie. And you need to decide how and when you're going to pay your creditors. And then there's things like taking customer deposits. So for example, if you're a furniture retailer, should you be taking customer deposits? Would be normal part of your practice. The counsel of perfection would be to put those monies into a trust account, such that if the business did fail, then those customers would be able to have those deposits repaid. But I appreciate that can be difficult, because businesses may well need that cash flow to be able to buy in their supplies. So it is a difficult one.
Yeah, indeed. What about the turnaround plan, though, if it fails, Sandra? What's the situation there? What's the immediate future look like for the directors?
Yeah, so you're probably going to end up in a formal insolvency procedure. we will all have heard of administration, a creditor's voluntary liquidation, and a company voluntary arrangement, which has been very prevalent in the retail sector. If there is an administrator or a liquidator appointed, then the administrator and the liquidator have an obligation to investigate the conduct of the directors that held office in the 3 years prior to the insolvency, which is why I was talking about how to mitigate some of those risks just a moment ago. That report goes to the insolvency service for them to decide whether it's appropriate to bring disqualification proceedings against directors, but also that investigation is used to establish whether there are any grounds for bringing actions against directors, and that would be to recover monies from them. And of course, if during the course of my investigation I uncover any criminal activities, then I need to report those as well to the relevant authorities.
So will the liquidator or the administrator, Sandra, seek to recover monies personally from the directors?
Yes, that can well be the case. There are a number of actions that we can bring. One would be for misfeasance or breach of the director's duties, which again was why we were talking about recording the decisions of the board and to meeting regularly. More rarely, we do sometimes see falsification of books and records, and desperate people do desperate things in desperate times. So just be aware of that. Wrongful trading, the government have suspended the provisions of this until the 30th of June, and that may well be extended in light of the coronavirus, but that is where a business continues to trade at a point in time when the directors knew or ought to have known that the company was insolvent and that there was no prospect of avoiding an insolvent liquidation. And they continued trading on, and the position got worse for the creditors. So for example, 6 months earlier, the liability to creditors was £500,000, and by the time the business went into an insolvency procedure, creditors were owed, say, £1 million. Then the increase of that liability of £500,000 could be something that a liquidator or administrator would ask the directors to repay. Fraudulent trading, so the business has either been set up for a fraudulent purpose or undertakes a fraudulent trade, fairly rare. Transactions at an undervalue, this is probably going to be pertinent going forward. So if, for example, the directors see the writing on the wall for the existing business and decide that they're going to start again, but some of the kit might be quite useful in the old business for a new business, and they transfer that at either gift it to a new company or transfer it at an undervalue, a claim could arise there. And also preference, that's the one that I see most frequently is, for example, where directors have personally guaranteed an overdraft facility, and the overdraft facility in the last few months prior to the liquidation has come down, but the creditors have gone up. So basically, what's happened there is that the creditors are funding that, or repaying the bank because you're not paying the creditors. And the directors then get the benefit of not having to repay their personal guarantee.
Yeah, so that's interesting. You mentioned personal guarantees there, but there's probably other factors. What, most directors rely on the businesses to provide for their families. So what is other impacts on them personally if their business does fail?
Yeah, it's a very good point. I mean, as you say, most directors will rely on their business for their income, their salary, their dividends, and that supports their family. And quite often you find more than one family member working in a business. So if that business does fail, then there's a significant and wide-ranging implications for the family. Directors will often have also supported the business by putting in loans to the company. They will be at jeopardy. They're likely to be an unsecured claim against the company if the company fails. And then there's things like personal guarantees. So if a director has personally guaranteed something, and they might be asked more frequently for personal guarantees going forward as suppliers get more nervous about supplying businesses in that twilight zone for a personal guarantee. If you're the company asking for that personal guarantee, do be a little bit wary of the director that gives you that says, yep, not a problem, and signs a personal guarantee and returns it straight away, that may suggest that they have maxed out their own personal position, and one more guarantee really doesn't make any difference because they've used up all their available assets. And then there's credit cards. You will quite often be issued a business credit card and it will be your name at the bottom of the credit card. Look at the small print, and quite frequently, if the business fails, the card holder named on that card may be personally liable for the debt that's incurred on that card. And then, of course, I was talking about the piercing of the corporate veil and the insolvency practitioner asking directors to repay monies. So
do you think that'll start again?
Yeah, that's an interesting one, isn't it? I don't know is the answer. If you've been a business owner for a number of years, maybe a decade or two, going back into the world of employment versus being self-employed and starting a new business, that could be quite tricky. And also, finding employment in this time might actually be quite difficult. So you might have to be really quite flexible with what you do going forward. You could look to restart. There's good and bad phoenixes, tend to get a fairly bad press, but it doesn't mean to say that they are always a bad thing. And we might see a few more of these in the current climate, where really the only buyer in town is the existing management team that happen to really understand and value that business, but for something like coronavirus would have been a pretty profitable company. And then there's the pain of starting up again, and I'm pretty sure, Fiona, that you've seen many startups and would understand the teething problems that with those new businesses, which leads me on to quite nicely, Fiona, what opportunities do you see coming out of the sort of coronavirus?
Yeah, I think you're right. I think there will be some. Sometimes, if you're looking on a pessimistic side, you might struggle to perhaps to think of them. But I think there will be opportunities, and it won't, of course, only be people who are already business owners and self-employed, but there will be, I think, employees coming out of the COVID period who are actually, unfortunately, no longer in employment. And they'll be looking around to see, are there some opportunities for them? I think there will be entrepreneurial opportunities. There always are coming out of difficulties. And a sort of particular example, I think, at the moment or in the future years is going to be in the green economy. I saw something this morning, actually, calling for green and socially just recovery plan from the government. And of course, they've got this commitment to net zero carbon by 2050. So I think there'll be some opportunities in those sorts of sectors and others. And, some may take the opportunity to shift to a new sector, a new type of business, possibly also take the opportunity to upskill at the same time, take that forced change upon your life to really reanalyze what you want to do with it. But apart from entrepreneurial opportunities, Sandra, I think you did mention that some opportunities arising out of insolvency procedures, because as you and I both know, often there can be a business can fail for want of really very little, a very small amount of cash can cause a business to fail.
And it could work as a fantastic bolt-on to an existing facility, especially if you can cut out a sort of duplication of costs there.
Yeah, no, absolutely. So I think we'll see quite a lot of opportunities, possibly not immediately, but as things evolve, I think people are entrepreneurial by nature, and I think we'll see quite a lot of opportunities there.
Okay, so Fiona, if you were looking for help and advice during this time, where would you go? This is the sales pitch, I think.
Yeah, so I mean, obviously, I would say both myself and Sandra are very, very willing to speak to people, to take inquiries. Also, your regular contact at James Cooper Creston. I put you in the direction of our practical guide. We started it right at the beginning of the problem of the crisis, and it's being updated regularly as new guidance comes out. We're updating it. And then outside of the James Cooper Creston bubble, there's an almost overwhelming probably amount of guidance available. HMRC, other government websites. For those sort of finance directors and finance controllers amongst you, the accountancy bodies are putting out some extremely good guidance. So I suppose, the summary is, I say, don't hesitate to get in touch with us, even if actually all you want is a steer to some good guidance. Is there anything, Sandra, that you want to add to that?
I don't think so, but we've got Lizzie working behind the scenes, sort of running the PowerPoint here for us. Lizzie, have you received any questions at all?
Hi, Sandra. No, we haven't received any questions today, so feel free to wrap up the webinar.
Thank you. Thank you ever so much, everyone, for listening. Very nice to speak with people, and hopefully we can meet again in person in the weeks and months to come.
Indeed. Thank you all.